Have you ever wondered why millions of people work hard their entire lives, yet only a small percentage achieve true financial freedom? Is it because they earn more money? Are they simply luckier than everyone else? Or do they know something that most people don't? If we look at the life of Warren Buffett, the answer becomes surprisingly clear. Buffett didn't become one of the world's greatest investors by chasing shortcuts or taking unnecessary risks. Instead, he followed a set of simple principles that remained unchanged for decades. These principles helped him build wealth through discipline, patience, and smart decision-making rather than excitement or speculation. According to Warren Buffett, investing isn't about predicting the future or finding a secret formula that nobody else knows. It's about making sensible decisions consistently over a long period of time. That's why, even after more than 70 years in the investment world, Buffett continues to teach the same lessons. They aren't complicated, but they require discipline to follow. In today's video, we're going to explore the 7 investing rules that have shaped Buffett's entire philosophy. Think of this as the complete roadmap. In the next episodes, we'll take each rule individually and explain it in detail with real-life examples, stories, and practical lessons. But before diving deeper, let's first understand the foundation of Buffett's investing mindset. Rule number 1, pay yourself first. According to Warren Buffett, one of the biggest financial mistakes people make is treating saving like an afterthought. Most people receive their salary, pay their bills, buy things they want, enjoy their lifestyle, and then try to save whatever happens to be left at the end of the month. Unfortunately, in most cases, very little remains. Buffett believes this habit quietly prevents people from building long-term wealth because they never make their future a priority. Instead of hoping to save later, he believes the first payment you should make every month is to yourself. The moment your income arrives, a portion of it should automatically go into savings or investments before you spend money on anything else. One of Buffett's most famous quotes perfectly explains this philosophy. He once said, "Do not save what is left after spending, but spend what is left after saving." This idea may sound simple, but according to Buffett, it completely changes the way people think about money. He believes wealth isn't built by making one extraordinary investment or earning an unusually high salary. Instead, it's built through small, consistent actions repeated over many years. The habit of paying yourself first creates discipline, and discipline eventually creates financial freedom. In our next episode, we'll explore why Buffett considers this one habit to be the starting point of every successful financial journey and how anyone can begin applying it, regardless of their income. Rule number 2, invest in yourself. When people think about Warren Buffett's greatest investments, they usually mention companies like Coca-Cola, Apple, or American Express. But according to Buffett, the best investment he has ever made wasn't in a company. It was in himself. Throughout his career, Buffett has repeatedly explained that improving your knowledge, developing valuable skills, and building good habits will always produce greater long-term returns than chasing quick profits in the stock market. Money can be lost, businesses can fail, and markets can crash. But the knowledge and experience you gain stay with you for the rest of your life. That's why Buffett believes personal growth should always come before portfolio growth. One habit Buffett is famous for is reading. He has often shared that he spends several hours every day reading books, newspapers, annual reports, and business information because he believes knowledge compounds over time in exactly the same way money does. Every book adds a new idea, every lesson improves your judgment, and every better decision increases your chances of long-term success. According to Buffett, the more you invest in yourself today, the greater your ability to create wealth tomorrow. In the next dedicated episode, we'll explore why Buffett calls self-education the highest return investment anyone can make and how this principle has guided almost every major decision throughout his remarkable career. Rule number 3, never invest in what you don't understand. According to Warren Buffett, one of the fastest ways to lose money is by investing in something you don't fully understand. Every year, new companies, industries, and investment trends attract millions of people. Social media is filled with success stories, financial news creates excitement, and many investors start buying simply because everyone else is doing the same. Buffett has never believed this is the right approach. He believes that before investing in any business, you should understand how it makes money, why customers continue buying its products or services, and whether that business is likely to remain successful for many years. If those questions cannot be answered clearly, Buffett believes it's perfectly acceptable to walk away from that opportunity. Missing one investment is far better than risking your money on something you don't truly understand. Throughout his investing career, Buffett has often spoken about staying within what he calls his circle of competence. According to him, every investor has areas they understand well and areas they don't. Successful investors aren't those who try to know everything, they're the ones who honestly recognize their limits. Buffett believes there will always be another investment opportunity tomorrow, so there's no need to chase every trending stock or fashionable industry. Patience and understanding are far more valuable than excitement and speed. In the next dedicated episode, we'll explore how Buffett used this principle to avoid some of the biggest investing mistakes in history, and why understanding a business is one of the strongest forms of risk management. Rule number 4, think long-term. One of the biggest differences between Warren Buffett and the average investor is the way he thinks about time. According to Buffett, most people enter the stock market hoping to make quick profits within weeks or months. They constantly check stock prices, react to daily news, and become nervous whenever the market falls. Buffett believes this short-term mindset is one of the biggest obstacles to building lasting wealth. Instead of asking what a stock might do tomorrow, he asks what a business could become 10 or 20 years from now. His focus has never been on short-term price movements, but on the long-term strength of the business itself. That's why Buffett spends far more time studying companies than watching stock charts. Buffett often says, "Our favorite holding period is forever." According to him, this doesn't mean an investor should never sell a stock. Instead, it reflects the importance of buying businesses that are strong enough to remain valuable for many years. Buffett believes that time is one of the most powerful forces in investing because it allows both businesses and compound growth to work together. Unfortunately, many investors become impatient and sell good investments too early, missing the greatest period of long-term growth. In Buffett's view, real wealth is rarely created through constant buying and selling. It's created by making smart decisions, staying patient, and allowing time to multiply those decisions. In the next episode dedicated to this rule, we'll understand why Buffett considers patience one of the greatest competitive advantages any investor can have. Rule number 5, ignore the crowd. According to Warren Buffett, one of the biggest mistakes investors make is allowing other people's emotions to control their financial decisions. When stock prices rise rapidly, excitement spreads everywhere. Financial news becomes optimistic. Social media is filled with success stories, and people start investing simply because everyone else seems to be making money. On the other hand, when markets fall, fear takes over. Investors begin selling in panic, believing that everything will continue getting worse. Buffett believes both situations are dangerous because neither decision is based on logic. Instead of following the crowd, he believes every investment should be based on the actual value of the business. If a company's long-term future remains strong, short-term market emotions shouldn't change your decision. One of Buffett's most famous quotes explains this philosophy perfectly. "Be fearful when others are greedy, and greedy when others are fearful. According to Buffett, this isn't advice to blindly do the opposite of everyone else. It's a reminder to stay calm when emotions take over the market. Throughout his investing career, Buffett has shown that independent thinking is often more valuable than following popular opinions. Markets will always move between fear and greed, but disciplined investors don't allow those emotions to control their actions. In the next episode dedicated to this rule, we'll look at real examples where Buffett ignored market panic and why thinking independently became one of the biggest reasons behind his long-term success. Rule number 6, stay away from bad debt. According to Warren Buffett, building wealth isn't only about making good investments, it's also about avoiding bad financial decisions. One of those decisions is accumulating unnecessary high-interest debt. Buffett believes debt can quietly destroy wealth because while investments use compound interest to help your money grow, debt uses the same principle to make your financial burden even larger. Every month, that expensive debt remains unpaid. It becomes harder to build wealth because a portion of your income is working for lenders instead of working for your future. That's why Buffett believes protecting your money is just as important as growing it. Buffett has often explained that financial freedom isn't measured by how much money you earn, but by how much control you have over your finances. Many people receive salary increases throughout their careers, yet they never become financially secure because their expenses and debts grow just as quickly as their income. According to Buffett, true wealth begins when your money starts working for you instead of being consumed by unnecessary obligations. In our dedicated episode, we'll understand the difference between productive debt and harmful debt, and why controlling debt is one of the strongest foundations for long-term financial independence. Be patient. If there's one quality that defines Warren Buffett's investing career more than anything else, it's patience. According to Buffett, the biggest mistake many investors make is expecting extraordinary results in a very short period of time. They buy an investment today and hope to become wealthy within months. When that doesn't happen, they lose confidence and move on to something else. Buffett believes this constant search for quick success prevents people from experiencing the true power of long-term investing. Great businesses need time to grow, and great investments need time to compound. Real wealth is built slowly, not instantly. Throughout his career, Buffett has consistently demonstrated that patience isn't about doing nothing. It's about giving good decisions enough time to produce meaningful results. He believes successful investing is less about making hundreds of perfect decisions and more about avoiding major mistakes while remaining disciplined year after year. The world often celebrates speed, but Buffett's journey proves that consistency usually wins in the long run. In our final episode dedicated to this rule, we'll explore why patience became one of Buffett's greatest competitive advantages and how adopting the same mindset can completely transform the way you think about money and investing. These 7 investing rules have guided Warren Buffett throughout one of the most successful investing careers in history. What's remarkable is that none of these principles depend on luck, complicated strategies, or predicting the future. According to Buffett, lasting wealth is built through simple habits, rational thinking, continuous learning, and the discipline to stay focused even when everyone else is reacting emotionally. That's why his philosophy continues to inspire millions of investors around the world, regardless of age or experience. Today's video was designed to give you the complete roadmap, but understanding these rules is only the first step. In the next episode, we'll begin with rule number 1. Pay yourself first and explore why Buffett considers it the foundation of every successful financial journey. We'll look at the psychology behind this habit, the mistakes most people make, and the practical steps you can take to apply this principle in your own life. If you want to build wealth the way Warren Buffett believes it should be built, you won't want to miss the next episode.